Let's make budgeting for your small business easy by using practical strategies to help you manage your finances in 2024. You're already one step ahead if you know how to use spreadsheets and accounting software like QuickBooks. However, that's only one half of the equation. You also need to understand the common strategies to effectively manage your budget and avoid shuffling between endless spreadsheets. That's why I created this easy 9-step cheat sheet so you can start managing your business efficiently right away. The first thing you need is a structured budget process. Without it, budgeting can become chaotic and costly. There are 5 key components every budget process should include. Budget period. This is used to compare data of when budgets are created, reviewed, implemented, and evaluated against actual performance numbers. Your budget period could be quarterly, annually, or any other time frame that suits your business needs. Budgeting method. This is how you plan to create and record your budget. Will you start from scratch with zero-based budgeting, or will you use past results and adjust them using incremental budgeting? Both are valid options, just depends on what you need for your business. Budget involvement. For this one, you need to ask who will be involved in creating the budget. Is it top-down with only senior management involved, or will you take a more collaborative approach involving team members at various levels? Again, it depends on what works best for your business. Budget committee. It's crucial to list out who oversees and approves the budget. For small businesses, this might include you, the owner, along with key team members like your finance officer or your accountant. Budget manual. These are the guidelines for creating the budget. It ensures consistency and fairness in the budgeting process, helping everyone stay on the same page. And that's all you need to set up a budget process. If you use tools like QuickBooks, it can simplify this process by offering features that let you create and manage budgets easily, ensuring you input all these key components. Once you have your process in place, the next step is to determine the key assumptions for your budget. These assumptions are important because not all information is readily available at the time of budgeting. For example, consider assumptions such as sales forecasts, cost per unit, inventory needs, cash flow patterns, and estimated discounts and sales returns. These assumptions should be based on past experiences and realistic projections. The better your assumptions, the more accurate your budget will be. Over time, as you refine your budgeting process, you'll identify more assumptions to include, making your budget even more robust. Next, we have the sales budget, arguably the most critical part of your overall budget. Typically, your sales department is responsible for forecasting and creating this budget, so it's essential they use the right methods to make accurate predictions. Here's how to create it. First, gather historical sales data. A good place to start is by collecting sales data from previous years. Look at month-to-month sales trends, seasonal fluctuations, and any significant events that impacted sales. Second, analyze market trends. Researching current market trends can help you understand how your sales are influenced. This could include changes in customer behavior, new competitors entering the market, or economic factors. Next, consider customer demand. Use your understanding of customer needs and preferences to estimate how demand might change and therefore affect your overall budget. After that, you'll want to make adjustments to your budget if you plan to launch new products or services. Even if they're small changes, it's important to note every minor cost difference. Follow that up with setting realistic sales targets. Do that by combining all this information to set realistic outcomes for your chosen budget period. Finally, review and revise. By reviewing your sales budget with key stakeholders, you can ensure it aligns with your overall business goals. Following your sales budget, you'll want to focus on your inventory and purchases budget, particularly if you're in a merchandising or manufacturing business. This budget outlines the number of units you'll need to meet your sales demand. It helps to ensure you have enough stock on hand to fulfill orders without overstocking and tying up cash in unsold inventory. Remember, the standard cost of inventory plays a significant role here. It's essential to set these costs carefully to reflect realistic budget expectations. After determining your inventory needs, the next step is to create the cost of goods sold budget, also called COGS. This budget estimates the cost of goods sold for your products, which is crucial for preparing your pro forma income statement. By knowing your COGS, you can better estimate your gross profit and ultimately your business's profitability. If you don't know how to create a COGS budget, here's how you do it in 4 steps. First, calculate direct material cost to determine the cost of raw materials needed to produce your goods. Multiply the quantity of materials by the cost per unit to get the total direct material cost. Next, estimate direct labor cost associated with producing your goods. This includes wages, benefits, and any other compensation for the workers directly involved in manufacturing your products. Then factor in overhead costs such as utilities and building rent. Lastly, sum it all up by adding together your direct material cost, direct labor cost, and overhead cost to get your total COGS. Yeah, that's a lot of math. I recommend using software like QuickBooks to simplify this process because it can track material and labor costs as well as allocating overhead expenses, ensuring your COGS budget is accurate and easy to update. Another critical component of your budget is the sales and administrative budget. As the name implies, this budget covers all your sales, office, and administrative expenses. These are mostly fixed costs that don't vary much from month to month, such as salaries, rent, and office supplies. Even though they are fixed, keeping them under control is essential for maintaining healthy profit margins. So don't ignore this one just because it's less complex than the other budgets I've mentioned so far. Now let's move on to the capital budget. This budget shows all planned capital expenditures for the year, such as buying new equipment or taking out loans. You can create one in 3 steps. 1. Identify potential capital expenditures. Start by listing any significant purchases or investments your business may need to make in the coming year. 2. Estimate cost and funding sources. Once you've identified potential expenditures, you can estimate the cost of each item. Then, determine how you will finance these expenditures. And then 3. Prioritize and schedule expenditures based on urgency and potential impact on your business. Time to focus on the cash budget, the one budget that ties all the others together. Your cash budget shows all the cash inflows and outflows for your business, helping you manage liquidity and ensure you have enough cash to cover your expenses. To create this budget, you'll need to do the following. 1. Forecast cash inflows. Estimate all incoming cash for the budget period, including sales, accounts receivable, loans, and investments. 2. Estimate cash outflows. Outline all expected expenses such as rent, payroll, utilities, and loan payments. Be sure to include seasonal variations and one-time costs. Then 3. Monitor and adjust your budget. Do this by regularly comparing your actual cash flow to your budget, or adjust your spending or budget to stay on track if discrepancies arise. The ultimate goal of budgeting is to create pro forma financial statements that reflect your expected financial position. Your pro forma financial statements typically include 3 key documents. There's the pro forma income statement, which projects your expected revenues, expenses, and profits, helping you set realistic financial goals by identifying potential profit margins and cost management opportunities. Next, there's the pro forma balance sheet. It provides a snapshot of your projected assets, liabilities, and equity, allowing you to assess your financial position and track progress towards stability and growth. Then there's the pro forma cash flow statement. It forecasts cash inflows and outflows, ensuring you maintain sufficient liquidity to meet obligations and capitalize on opportunities. With all these business budget strategies in mind, let's touch on some common problems you might encounter during the budgeting process. Budgetary slack occurs when managers intentionally overestimate expenses or underestimate revenue to make their jobs easier. It can lead to inefficient use of resources and misaligned goals. Goal incongruence happens when individual goals don't align with the overall business objectives, leading to conflicts and inefficiencies. Budget myopia arises when focusing too much on short-term goals without considering the long-term impact that can hurt your business in the long run. Lastly, standard setting of unrealistic expectations can lead to frustration and demotivation. It's essential to set achievable yet challenging goals to keep your team motivated and on track. Now, I know everything I explained about budgeting sounded complex and daunting. However, with the right approach and using the budgeting strategies I listed, you can set your small business up for success in 2024. And if you're ever unsure of what to do, remember to create a structured process, make realistic assumptions, and watch out for common pitfalls. If you found this video helpful, don't forget to subscribe to our channel for more small business tips and tricks. And if you're ready to take your budgeting to the next level, check out QuickBooks to see how it can help you manage your finances with ease. You can find a link to it in the description below. Thanks for watching and happy budgeting!